All right, in this lesson, we're going to go over 3 ideas or 3 topics that you really need to understand when you are talking about auditing. Now, these 3 things are basically giving you a lens to when you're walking into an audit, things to keep in mind when you're doing an audit. And so these are very important, but it will give you a contextual understanding of why we do what we do or why we're doing something that we may seem a little bit odd at the end of the day. The 3 things that we're going to be talking about in this lesson are materiality, audit risk, and audit evidence. So let's start with materiality. So materiality is information is material if omitting it or misstating it could influence decisions that users make on the basis of the financial information of a specific reporting entity. And so what we're saying by materiality is that if I omit it, it would have an adverse decision of the decision maker. Okay? They need that information to make a proper decision. So an example might be, let's assume that you're a college student, and if you're a college student, you know what I mean, and I give you $100. And then let's say a couple hours down the road, you lose it. Is it going to hurt you? Probably. And I don't mean physically, I mean it's going to mentally hurt you. You're going to be a little bit sick because that $100 is material to you. You don't want to lose it. All right, now let's flip the conversation a bit. Let's say you are a millionaire. I give you $100, and then you lose it. Is it that big of a deal? Probably not. Some would argue that it is, but it probably isn't. If you're a millionaire and you have $1 million, losing $100, not that big of a deal. But as a college student, losing $100, it's a huge deal. And so, what we say about materiality for the student, $100 is material to them. For a millionaire, $100, not material. So materiality is important because let's look at a financial statement of let's say $1 billion company. And they lost inventories of $1,000. So they just lost it. Don't know what happened, maybe damage or whatnot, it's in the trash. Does it really matter? Not really on a $1 billion organization. $1,000? Doesn't matter. So us as auditors, we may decide not to test it because if we test it, all we're going to get is, okay, it's right or it's wrong. Okay? So materiality says that materiality is the idea that if it's material to the decision maker, if it actually materially influences the decision maker in a different way, then it's material and it's important for us to look at. If it's not going to sway a decision maker, if we, let's say, have it on the financial statement or not have it on the financial statement, then it's not material. It's immaterial. For that millionaire, the $100 is immaterial to them. For a college student, 10 cents is immaterial to them. But $100 to a college student is material. That's what we're looking at when we're looking at a financial statement. Is it material? Is the information, segments of the information material to the end user? So that's what materiality is. An auditor's job is to determine how big does a misstatement have to be before it significantly affects the user's judgment. Now we're going to look at different things, but we're really looking at the nature, timing, and extent of our audit procedures to help us identify the misstatements here. Okay, so how big does a misstatement have to be before it significantly affects the user's judgment? So when we go do the audit, we're going to find mistakes, obviously. Are those mistakes material? And if they're material, does it have a material impact on the financial statement? If it does, the client needs to change it on the financial statement, or we might not issue a clean report on them. Okay, so that's what materiality is. The next one we're going to talk about is audit risk. Now, audit risk is the risk that the auditor expresses an inappropriate audit opinion when the financial statements are material and misstated. That comes from AU 320. Now, what we're saying with audit risk is there's always going to be a risk. We can gather all the evidence we want. There's always going to be a risk that we're going to say the financial statements are clean, but in actuality, they're not clean, and they're not clean materially. Now, I keep using this idea of materially. Our job is to find reasonable assurance, not absolute assurance. What's the difference? Reasonable means that we're going to look at all the material information, the material items on the financial statement. we're not looking for absolute, which means I'm not looking at every single freaking transaction that the business does. Okay? If I did, that would give me absolute assurance, but that would also cost a lot of money, okay, to do, because I'm going to have a lot more manpower, and we're going to look at each individual item. Now, if you are a researcher, you know that we can do sampling techniques. So I don't need to see everything. I can see a sample and infer that sample on the population. Statistics, if you're taking statistics. So we're going to do a sample to infer over the population. It's a lot cheaper, and the difference to go from 95% assurance to 99 or 100% assurance is going to cost us a lot more than it is to go from 0 to 95. So to put that into your head, to go from 0 to 95, let's say it costs us $1 million to do the audit. But to go from 95% to 100% will cost us $10 million. Because now we're going to have to see everything. We're going to check everything. So the question is that extra 5% of assurance worth another $10 million in audit fees? And if you're like me, I'm going to say, no, I will just be 95% assured that the financial statements are correct and pay the $1 million, then have to pay $11 million to get 100% accuracy. Okay? And so that's what we're talking about with absolute versus reasonable assurance. Now, if I only go to 95%, is there a chance that I'm going to have some audit risk, the risk that I'm going to give the incorrect opinion? Well, yeah, because I'm not looking at 100%, I'm only looking at 95%. So there's this 5% chance per se that I'm going to have an incorrect opinion. I'm going to say that the books look right. In reality, they're not because of this 5% risk factor. That's audit risk. The risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. If they're materially misstated, it's that 5% chance that I'm going to have audit risk. How do I get rid of audit risk? Well, there's two ways. The first way, don't do the audit. The second way is that we audit everything, but cost versus benefit. The cost will outweigh the benefit. We're going to get just enough benefit in the 95% as we would get with 100%. Okay. Now, some might argue that that's why there's the downfall of audit firms like Auditor Anderson. But at some point, we have to be reasonably assured that we're okay with 95% instead of going all the way to 100%. If we go to 100%, that would increase the audit fees, which would increase its products and services, and then things won't become affordable, and then it's harder to run business that way. Okay? And the last one is audit evidence. Now, with audit evidence, for most of you might understand audit evidence. Audit evidence is gathering some type of evidence that will help you assess what you're trying to accomplish at the end of the day. Now, for us as auditors, we need to make sure that our audit evidence does two things: that it's sufficient in nature and that it's appropriate. Okay? So what do we mean by sufficient? The quantity of evidence is sufficient to get us to where we need to go. So for instance, if there is 100,000 transactions that we're trying to review, and we know that we need reasonable, and there's 100,000 transactions, maybe we look at 1,000 of them. Okay? Maybe if we take stats into play, statistically 1,000 is a good number. That's sufficient for that. Whereas maybe we want to look at only 10. Well, if we only look at 10, that might not be sufficient enough to then make an inference on the entire population. So this goes back to statistics a little bit and understanding that we need a sample population that is sufficient enough to give us the ability to infer something on a population. Okay? And inferring population is saying that because 10% of X, Y, and Z of this sample is this, then we can assume that 10% of the population thinks this way as well. That's what we mean by inferring. Okay? And then audit evidence has to be appropriate in nature. What do we mean by appropriate? It must be relevant and reliable. Relevant meaning specific to the assertion. It's got to be appropriate, relevant to the assertion, and it must be reliable. Can it be relied on to obtain truth in the account balance or assertion being tested? So relevant, specific to the management's assertions. Reliable, can it be relied? So for instance, with relevant, let's say I wanted to look at the cash balance. So I'm going to go get the bank statement. Does it do me any good to get the investment statement? Well, some would say yes, but no, because probably most of their cash is not in investments. So that might not be relevant enough. We might need a bank statement, which would give us more relevance to their cash balance. Okay. What about reliability? Reliability, can we trust it? Well, let me give you an example of trusting it. So you have two options. You can go to the bank and grab a statement from them, or you can go to management and have them pull the statement out of their files. Which one is more reliable? How about going to the bank and getting it directly from the bank? You might go, well, why is that? Well, the reason why going to the bank is more reliable, even though both statements may be the same, what's going to make it more reliable is you're getting it from the third party itself. What could happen if you get it from management? Well, what could happen is that when you get it from management, management has some time to doctor up the document to make it look better or to match what you're trying to audit. So when we talk about reliability, can we rely on the document? It's better to go grab the document from a third party or get a document from a third party than it is from the client, because the client has now been exposed to the document and they can now change it or doctor it or create a fake one. And because you're getting it from their hands, who knows where it was before it got to your hands? So that's important. The audit evidence must be reliable. Now, are there times when you're going to get audit evidence that has to come from the client's hand? Yeah, there are times when you're going to have to get stuff from the client, and that's going to be client information. You're going to have to do your best to audit that to make sure that it's that you can rely on it at the end of the day. Okay, so in this lesson we talked about materiality, audit risk, and audit evidence, the importance of the three. We also talked about what they are. You as an auditor need to understand materiality. You also need to understand that on the audit risk, we're looking for reasonable, not absolute, and because we're looking for reasonable, there's this chance over here, in our example, 5%, that we're going to issue a clean opinion, but in reality it's not clean because of this audit risk over here. And then audit evidence, making sure that your evidence is sufficient in nature and appropriate to what you're trying to audit at the end of the day. So that's this lesson on materiality, audit risk, and audit evidence. Hey, thanks for watching my video. If you like what you saw, make sure you press the thumbs up button that's right below here. If you have any questions, make sure that you leave a comment or that question in the comment box below. And if you haven't subscribed yet, make sure you press the subscribe button. It's just below me. Hey, if you want more videos like this, make sure you go to www.patrickleemsa.com to see more videos like this, or if you just want to learn more about accounting. Thanks for watching. We'll see you in the next video.